hitting forecasts actually even early is a pretty good sign that you're doing a good job. I would say some of our biggest and best companies, even early on, were very systematic about that. Obviously, they've made pivots along the way. That's another thing, by the way. Almost every single company, that's been successful at some point was probably doing something a bit different than what they were doing that ultimately made them successful. But definitely having that muscle of saying, okay, let me, present forecasts that I can achieve and, even beat many cases. I think that's actually a really good sign early on. It also, you definitely want, you want your founders in the companies to be visionary, but you also want them to be, realistic on some level as well. And also around things like recruiting, I would say a very early sign that we've seen in companies. If you might think the CEO is amazing, but you want to see that they can recruit amazing people. Now, typically, we're not getting involved in the companies directly until they're at the growth stage, but we are seeing through our fund managers and the portfolio funds when they invest very early. We spend a lot of time meeting the underlying companies even well before we're going to invest. And what we try to do is meet more than just the CEO and look at the backgrounds of the people that they're able to recruit. So I think another telltale sign, again, is just seeing the way the founders and the CEOs build out the team with quality people. I mean, I think that's a very good early sign if you see that.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Abe Finkelstein is the general partner at Vintage Investment Partners, an LP designed to have three strategies: a fund of funds, secondaries, and growth. They have a 90% re-up rate, something I promise we'll dive deeper into. Abe's a Baltimore boy and now spends most of his time in Israel. He's a proud graduate of both Wharton as well as the Hebrew University of Jerusalem. We assure you we'll cover a lot of ground here, enough to make it to Mount Everest and then back. But for now, Abe, welcome to the show.
Thank you. I really appreciate that. It's great to be here, David. Thank you.
That's amazing. Well, Abe, I don't know if you can tell here, but I'm more nervous than I am on a first date. It's been a while since I've been on a first date, but I'm shaking you because I've chatted with quite a few individuals, and a lot of them are like, oh my God, Abe's amazing. The way he's thought about, venture, secondaries over the years has been really transformative. And so you're like a celebrity in my head right now. And I'm talking to the Ryan Reynolds, Chris Hemsworth, name whatever celebrity. And so my heart's pumping. So we can start in a million places, but in terms of where to start in the beginning, I thought maybe we start at your first job out of school. So as someone who got his first job through with a local stockbroker back in Baltimore for peanuts, writing newsletters about Israeli shares that goes on the NASDAQ, how did you get your first boss to say yes?
So first of all, I appreciate the intro and you setting the bar so high. So good luck to us all. But just to give you a little bit of background, so I studied, I did do my first year of university at the Hebrew University in Jerusalem and just fell in love with Israel. And that's what got me back to here a few years later. And I've now been here for about 23 years. And then I finished my degree at the University of Pennsylvania at the Wharton School, basically graduating, with a degree in finance. So I really wanted to figure out how to get to Israel and combine Israel with finance in some way and with my career. And this was 1994. And I honestly didn't really know what that was. And I had, did the basic, route that kind of all the graduates of Wharton do and, go to the interviews for the consulting jobs, for the investment banks and what have you. Nearly all of them up in New York, as you can imagine. And either it wasn't interesting to me or I wasn't interesting to them. And I found myself kind of back in Baltimore at my parents' house after graduating, trying to figure out what's next. And as luck would have it, my parents actually told me about this guy in Baltimore who, again, as you called it, was a stockbroker. I find myself to at least younger people having to explain what that is sometimes. But he was pretty ambitious himself and he wanted to be more than that. And he was, also had an affinity for Israel and Israeli tech and shares traded in the US and started to carve out a niche by writing to his clients about Israeli shares traded on NASDAQ. And I was like, wow, this actually sounds exactly what I would, want to do. Not 100% know exactly what equity research was and what it meant to go, if this guy could even pay me. But I met him and I told him I was interested in joining him to help him out. And he basically said yes, and then told me, as I said, he didn't have anything to pay me at that point. So would I join him as an intern? And I kind of looked at all my options, and obviously I didn't love that being the situation. It was a bit of a hard blow after graduating, but I said to myself, this is definitely something, at least directionally, that I want to do. So let me try it out. And I told him, would love to come do whatever you'd like me to do. My first day was actually organizing his files. So, it tells you a lot, but, it was sort of, I say it was sort of the Karate Kid moment of wax on, wax off, where he basically said, start diving into the basics and kind of learning everything from the bottom up. But basically that's how it happened.
I have a couple questions there. Mm-hmm. We'll take it one by one. You mentioned something earlier about you were looking for people who are ambitious. You were looking to work with people who are ambitious. If you could recall, this is obviously more than 2 decades back, if you could recall what about him stood out in terms of being ambitious, because on paper, as we mentioned earlier, he's a stockbroker based out of Baltimore, writing newsletters about Israeli shares, which even at that point is a very nascent market. What about that stood out as ambitious to you? Was there anything he told you or your parents told you that stood out?
Yeah, so it was very interesting because I actually, when I first met him, he was suit and tie, stockbroker, looked the part. He was extremely personable, and charismatic and funny, which I really liked. But I found out afterwards he never graduated from college. So it was actually something that he just started doing on his own and learning the business. And he was working, again, in what you would think of kind of a stock brokerage firm that was basically like taking trades and helping their clients invest. But again, he wanted to do something more than that. So it wasn't something that the firm was saying, hey, go do this. He actually decided that he wanted to go do this and start focusing on this niche, seeing something that was interesting and new, something that was emerging, and again, taking it to the next level and writing newsletters at the time, what we called it, but research on these stocks, which wasn't part of the job. This firm was using other people's research in order to, pitch various stocks. So it just stood out to me right away that he was very, even entrepreneurial is what I would call it. And again, so there's ambitious and entrepreneurial. So I think it was just very entrepreneurial. And I would say kind of that has, been a common thread throughout my career, although I never really thought of myself in any kind of way being an entrepreneur. I look at what entrepreneurs do every day, either directly through our strategies or through the funds. And I just think they're much more, talented and taking big risks. But there is that kind of entrepreneurial element that sort of went through the various stops along my career. So again, just very different. Again, graduating from Wharton, going up to Wall Street and seeing all these people are doing these, high-powered jobs. And then, this guy, again, who never graduated college, who was really, just trying to make a way for himself and doing something different that he liked. So that really stood out to me.
This is awesome. And I'm curious, you mentioned entrepreneurship being a theme in your life. I'm curious, while you were at Wharton, was that teased on campus? Was there because this person, this stockbroker, and I probably should get a name before I just keep calling him stockbroker. But he was entrepreneurial. That stood out to you because he did something that his firm was not telling him to do.
Yep.
Were you drawn to entrepreneurship before then, or was that your first interaction with entrepreneurship?
Yeah, I can't say that I totally was. I would say kind of looking back before then. I mean, again, even making kind of the decision to, go to university in Israel for a year after graduating high school. I'd only been there once before on a class trip. I was actually there during the first Gulf War. And that was also, very, very alarming and different from, experiences that I had. So it was like, being away from home for the first time, going overseas, and then hoping that, I'd already gotten into university, so I knew I had a place to go back to. I wasn't such a big risk taker, but hoping that maybe I could get some credit for what I did in Israel. So I definitely think, it was definitely taking a little bit of a different path in that sense. I would say, going back, to Wharton and Penn at that time, entrepreneurship, and that wasn't like a course or a class, at least not much, at least to the extent that I remember. So it was a little bit less so. But I grew up in we talked about this a little bit in Baltimore, and always kind of had that second or maybe third or fourth tier city chip on my shoulder, and I think that really was more of what impacted me. As opposed to specifically saying, oh, it was entrepreneurship, or I thought about that, like I wanted to do my own thing and start my own business or those types of things. But it just sort of happened. I always, even as I progressed through, we basically what ended up happening was that after I started working with him, Israel started to become a thing, tech started to take off, and we were hired away by another investment bank. And that's when I actually started getting paid. But it was always in a small group. It was me, him, and one other analyst. And then even when I went to Goldman Sachs, which was kind of like ultimately getting the dream job and working with the Israeli team, I was working with a 4 or 5 person team. Moved over to Israel. It was like this small team within this massive organization. So I always appreciated kind of working in a smaller group where you really felt like a team, like you were really a team. It was almost like a basketball team. I grew up playing sports. I knew the benefits of doing those things. So I would say within that context, yes, I always like kind of being in these smaller groups that in some cases in a large organization, but that was really important to me as well. And I do think that's the case with entrepreneurs. Again, they're starting something from scratch, and they know for a while it's probably going to be a relatively small team where you have to again organize the files and close the deals and do a little bit of everything. And you're not you're doing things from A to Z. So again, it wasn't a conscious intentional decision, but it does feel like something that's been relatively pervasive through my career.
I love it. To rewind ourselves back a little bit, I think we've established that you were enamored by this role, and you're like, I've got to work here. And I have 2 follow-up questions. We'll start with one, which is, what was the flip side? If you can attribute this to speculation, if this as much as you can, but at the same time, you kind of took a couple leaps of faith in the story, where you had the conversation with him, and then 2 sentences later, he was like, yes. What was that span in the middle that allowed him to say yes? Was it because you graduated from Wharton? Was it because you were emailing, or not emailing, but maybe calling him every single day, and he's like, I've got to work here? What stood out?
Yeah, no, I think that's it. I think he liked the combination of having somebody on his team that actually, kind of had some degree that maybe meant something that could be a calling card. And but look, I think he just saw that I was really eager to do it. And again, let's be honest, like not everybody was going to go work for free, or in that sense could work for free. Again, it wasn't pleasant having to go back home to live with my parents. And in fact, I think my parents as well, as much as they were supportive, I think they were like, wait a second, what's going on here? You graduate, you should go get a paying job somewhere. So I'm not sure they were like super thrilled with me, doing something that wasn't paid at the time. But I think that was it. I think he was, again, maybe it was just, again, that I would work for free, but I think he was seeing somebody that would work hard for him. I also think there was an element of he didn't know me and I didn't know him before, but I think we developed a rapport, and he could probably see, and this is very important through a number of different meetings, that I was somebody that he could trust. Again, you never know, but that's really critical to try to understand. When we talk about investing, whether it's in funds or companies, you really want to try to build a rapport with people over time and get a feel for these people you can trust, because you never know how long you're going to have to work with them, and usually it's for a very long period of time. But I think it was just, again, I was very eager. It was I ticked a lot of boxes given my background. And again, I can't discount that. Again, I was willing to do it for free was probably a big calling card.
I bet. And then, I mean, there's so many factors here. Obviously, your resume probably at that time looked better than I imagined a lot of other applicants to that role, or if you were looking at other applicants. You were also willing to do it for free, which is a very hard thing to do, especially when you graduate from college or even like one of the most elite institutions in the world. You mentioned that it was important to establish trust in the very beginning. Was there anything you did in particular, if you can remember, that helped you establish trust? And I'll buy you some time here because typically when I talk to founders and when I tell founders like, hey, what's the goal of the first meeting? The goal of the first meeting is not to get the term sheet. You're not going to get a term sheet within one meeting, right?
Yep.
The goal of the first meeting is always to teach the other person, or in this case, the investor, something new that they're curious enough that where they come back for a second meeting and a third meeting and all that. And so the optimizing for teaching something new is something I often tell founders and at this point, often investors as well. But for you, was there any framework you were thinking? It's like when I walk into this meeting, I have to do this thing in order to make sure I establish rapport and trust.
Yeah, look, I think a lot of it is just, kind of looking back and remember, is just being very sincere with him about my situation and what I wanted to do, just being very, very open. I don't want to necessarily, call it, vulnerable, but just saying, hey, look, I did the rounds in New York. Again, I couldn't find something I wanted to do and nobody wanted me, or, so there are those that did, it wasn't interesting enough. And, I'm here now and I'm willing to put in the hours. What I would say is, again, let's be honest, like it was very low risk that he was taking in that sense, because, there wasn't a financial risk at that point. And he could have just told me to go home if I wasn't working out. In the world of equity research, at least back then, you had to be in well before the market opened and get things done and prepared and be ready to go for any news that you had to share with your investors. So I think some of it maybe was after he hired me, and that, I was there every day at kind of 6:30 in the morning or whatever it was, with the suit and tie, raring to go. I think that, kind of quickly showed up that I was serious about the job. And I don't know, maybe I can be accused of having a in most cases, maybe a pretty serious demeanor when it comes to work. So, after a while, as I get to know people, I'll loosen up and joke around and stuff like that. But I think that was a lot of it. Just, again, being open and transparent with people. Clearly you always still want to be selling your strong points. But I always love, for example, when I'm talking to people to hear about things they learned about and their misses. I was talking to my partners the other day about hiring people. I don't love the answer when people say, okay, what's your if you had to pick something that maybe people would say hold against you, or say what's your downside, and they say, oh, I'm a perfectionist or whatever it is, or I just work so hard, or I work too hard, I need to take a break. I want to talk to people who've been through something, made mistakes, had learnings. I think that's really, really critical. And I'm sure when I was being interviewed for that job and with other jobs, I try to emphasize best to emphasize that as well. And that's what I want to hear from people that we invest in. I think that's really, really important, because again, people are going to make mistakes, and you're going to be working with these people for a very long time.
Are there any answers to what are some of your weaknesses, effectively that question, that you've heard that you were like, damn, that was a good answer?
Yeah, most of it, again, is around when people can bring up specific situations. So it's more the kind of take the question in another direction and say okay, where things didn't go well, where they failed, and what they've learned from that. It could be that, for example, that you take too long to make the tough decisions or something like that, and again, over time, you've learned to do that a bit better. I find that's always kind of a good answer, but I really think it needs to be attached to the learnings that you've had from mistakes. I mean, again, I appreciate the intro that you made, but we're still making mistakes till today. We just try to minimize them and correct them as soon as possible. And I think one of the things that at Vintage has been part of the culture is really people who take responsibility for the mistakes that they made. We have an offsite that we do 3 times a year, and it's really interesting because it's this type of session where we really kind of beat ourselves up about all the mistakes we make, and it's almost like whatever you want to call it, one of these anonymous type meetings where you go in and you say, hey, I'm Abe Finkelstein, and here are the mistakes that I made over the last year, and how do we do things better?
I was going to circle back to this later in the conversation, but since you've mentioned, I think it'd be a good segue to that. But you talked about mistakes, and you also talked about the fact that you have offsites 3 times a year, when it to talk about mistakes and to kind of go over what can we do better. Before we get into the mistakes part of it, I'm curious because I know we have a lot of LPs in the audience. Why you have an offsite 3 times a year? Like, was there a science behind the cadence in which you were having these offsites? Because I imagine this is a conversation that other family offices, institutions are also having within themselves.
Look, there wasn't a science, I think, and initially it was probably once or twice. But I would say this kind of simply, like you don't have time to kind of do it and to prepare for it properly more than 3 times a year. But you also don't want to wait too long between doing it because, again, this is a very dynamic market. Things change, as if from quarter to quarter, from half to half. We've grown in our various strategies. Sometime we'll spend at each offsite with 3 strategies a little bit more time on one of the specific strategies. But if you wait too long between them, then things can just fester, and you don't want to delay. But again, you don't want to delay. But doing it more than 3 times a year is just challenging time-wise.
I'm curious, you mentioned preparation. What goes into the prep of an offsite? What happens beforehand? When does the clock start ticking in terms of we need to start preparing for this offsite? Yeah,
it's usually probably about like a month before. What we like to do is kind of divide up topics between the team members. Occasionally there's a carryover topic that maybe we didn't get to. Occasionally there are new topics that kind of pop up in the interim that suddenly become much more important, kind of like, when the market turned and the bubble burst, like, how we did something specifically around like focusing on some of the direct investments we had to make sure that they were, well funded and, proper runway and so on and so forth. It's probably about a month and a half before we divide up, again, the topics among the team. Everybody comes in and, presents. It's usually 2 people working on a various topic. I want to say we get through maybe 5 or 6 topics. Each time it's full day. It's literally off-site. Like, we're not like flying somewhere, but we're kind of going down to the road to a room in a hotel and just kind of closing ourselves off there for from 8 in the morning until 6 or 7 in the evening. And again, it's very intense. There's a lot of and then a key thing is afterwards, obviously, is we want to hold ourselves to what we've said. So clearly we come out with action items. We always start the offsite reviewing kind of the topics that we discussed last time and what's come out of that, to see if we held ourselves to that. I would say we're not at 100% on it, but we're getting better at it over the years, and probably closer to kind of 80. But that's kind of how it's structured and it works.
On the topic of mistakes, and I mean, Abe, the deals in which you and your team do are massive in nature, and I imagine there's a lot of mistakes that can be blown in proportion just by the dollar amount that's attached with it. The question I have for you is, how do you make sure people check their ego at the door? Because when you start like pointing out mistakes, there's a very easy opportunity. I'm not saying this is good, but there's a very easy opportunity to point a finger as well.
Yeah.
And how do you make sure that people aren't egotistic, like going into this conversation and really looking at the problem here? And I want to be a little bit more surgical here as well, just to give our audience a little bit more context.
Yeah, no, 100%. I mean, first of all, again, it goes back to what we talked about. We want to recruit people with that kind of culture. Again, we're not perfect, and you can have that, ego issues. I would say, luckily, over the 20 years at Vintage, we haven't had too much of that in terms of issues. It's really something that Alan, who started Vintage, really instilled in all of us. And in a way, in many cases, Alan, in fact, will start up the offsite talking about the mistakes he made. And just very quickly, that kind of sets the tone. You can't be, it's hard to be pointing fingers and egotistical when, the managing partner and the guy who founded the firm is doing that. We get that also from him, and hopefully that's something, again, we'll be able to take going forward. But that's critical. It's just something that's pervasive in the culture. It sounds simple, but it's not at the same time. Like, it's really been the culture almost from the beginning.
And I love the fact that Alan ends up going on stage to share. I don't know if I'm talking on a metaphoric stage, probably over here.
Sure.
the fact that he goes on stage to share his own mistakes, because there's so much about the first 10, 30 minutes that sets the tone for the rest of the day.
Yep.
And it might sound simple, but trust me, if people do it, you'll realize the tone gets set very differently and people are a lot more open and vulnerable
100%.
than they would be otherwise.
Yep.
You mentioned action items, and keeping people accountable is very, very important. Something I constantly think about in my own work as well. How do you make sure people are accountable? Do you have systems set up to make sure people are accountable post those offsites?
Yeah, we don't, it's not systematized with software yet. I would like to get there, honestly. But, a lot of it, again, is just people taking their own responsibility around that. Again, we try to recruit people that are saying, hey, we need to get this done. This is what we talked about. We need to then, implement this going forward. And again, the checkboxes or the checklist is starting the next offsite and seeing, what we've done and what we haven't. What I like at our firm, again, we do have the classic case of having partners and principals and senior associates and associates. We give everybody a lot of rope here, to do deals, to be leaders. And in many cases, sometimes it's, the people who aren't the partners actually who are coming and saying, hey, guys, we talked about this at the offsite and, we haven't done this. Like we got to do this. And I appreciate that. So again, that's also part of the culture, is just having people like step up and try to move things along if we haven't gotten to it. So, but no, just going back to, it's not fully systematized, but hopefully we'll get there. We just hired a few months back a fantastic head of data. Data's always been important to us, and maybe there's a chance to even talk about that since we started. And originally it was just kind of, Word and Excel, but that was also a key part of our culture and ethos, is to gather as much data as possible. So, finally after, we built out a lot of systems. After 20 years, we have a very, very strong person who's going to be taking that going forward, and processes is definitely going to be a part of that. Not just around getting information about investments and analysis and things like that, but definitely using systems to manage processes.
Can we start expecting Vintage to put out a lot more reports in the future as you're amalgamating a lot of data in the market and what you're seeing?
Yeah, we would like to do that. I mean, again, I don't want to get anyone's hopes up that it's going to be tomorrow, but for sure, that's one of the goals that we'd like to do. We definitely, whether it's about funds that we invest in, whether it's about companies that we invest in, whether it's about the secondary transactions that we do. As you can imagine, we have a ton of data that right now we share that in many cases with our funds and with our companies sort of on an ad hoc basis. We do a conference every year, which we also show data to the industry. We do it without press, where we show industry to the data that, to the industry that we've been collecting. So it's definitely something that we want to, do more in the future. So I would say yes. My hope is, don't hold me to it, but maybe in the second half of 2024, we'll start seeing more of that.
Yes, I want to promise our listeners and viewers, or maybe not promise, but I want to mention to our listeners and viewers that this is not legally binding. If his team changes his mind at some point in the future.
Thank you.
I got you covered. I'll be your compliance officer for this conversation.
Appreciate that.
So I want to fulfill a promise back to our audience that I mentioned I bookmarked earlier in our conversation, which is the topic of mistakes. Has there been a mistake now or in the past that you'd be open to sharing for our audience? And it's okay if you abstract some of these names and situations, but I wanted to give our audience something concrete to go on when you talked about mistakes as a whole.
Sure. I mean, I'll tell you two things. I mean, again, I won't get into the specifics, but I would say, and again, it's a bit of a cliche, but it just holds true every time, is that we made mistakes around people, where we felt, whether it was the business or the fund or whatever it had, you just, looked fantastic and was doing great. And, maybe you had a little bit of concern about the people, whether it was the founder or CEO or whether it was a fund manager. And I would just say, I could say 9 times out of 10, but it might even be 10 times out of 10. When you have kind of those, butterflies in your stomach or whatever you want to call it, it's usually there for a reason. And in the vast majority of cases, those things go sideways. So I think it's just critical. And we definitely, like I said, I talk about kind of the learnings when we're hiring people, what we hear from, we definitely spend a lot more time as much as possible, which was, again, as you can imagine, a big challenge in kind of 2020, 21, which is why we slowed down our investments in those years to spend time with people and get to know people over cycles. So I think that's extremely critical. And I would say personally, most of my mistakes when I look back at the various memos that we've written where the concern somewhere in there was related to the people, they didn't go so well. The other thing I would say, and in the world of venture, I mean, sometimes you can be maybe even too conservative in a way. I would say the other mistakes we've made is where we've seen these, fantastic people and fantastic managers, great companies and great funds where we've kind of said, well, maybe there's a cap on what they can do. So I would say we've often kind of underestimated how big companies can get and how well funds can do when they have all the ingredients, and maybe invested a little bit too less, or even, again, underwrote to something that wasn't high enough, in a sense, meaning like their potential. So I think I would say those are kind of the mistakes that, if I had to highlight two that we've made over the years that we've been trying to correct for. We'll still make them here and there, but hopefully less. The other thing I would say is, again, we always underestimate, not always, but we try as to how long these things take. Again, to build a company, to see results from a fund. There's a few funds that we've been in where I would say kind of going into year 3, these funds are doing seed and early stage investments. And you get to year 3 and you kind of say, is anything going on here? I really love the managers and I love the bet that we made, but the portfolio kind of looks like it's meandering along. And then, suddenly 2 years later, it's like top 5% and, had some major exits and things like that. So you got to be patient with that stuff. Again, if you go back to your original thesis and it was around how great these people were on the fund side and their ability to attract amazing entrepreneurs, you gotta be patient with that stuff. It just takes time. Occasionally there'll be a rocket, but sometimes those even aren't real. But so you definitely need more patience. Made mistakes on kind of maybe bailing a bit too early on some stuff, or again, kind of maybe even selling too early on some stuff. In a lot of cases, we sold a lot on time. So I'm very happy about that. We got out of a lot of stuff in 2021 and did well on that. But in some cases, maybe we underestimated the potential because we didn't have the patience.
I think Cambridge Associates had a research they did at some point, and they found that it takes about 6 to 8 years before a manager falls into their quartile. Yeah. And I think Samir Kaji has also been on record to say, like, hey, it takes 7 years before a manager fits into their quartile. And it's so easy to look at early TVPI and IRR and make assumptions there. Yep. But as venture is the power law for the most part, we far and underestimate. I remember reading a Bessemer memo, and I love the fact that Bessemer has their memos online. Yeah. But in their Shopify memo, they at one point it was either $300 million or $400 million. That was the largest upside they expected for Shopify. Yep. Obviously, hindsight bias. Yep. It is much bigger than what Bessemer at least initially kind of like expected it to be. You talked about 2 archetypes of people earlier in terms of mistakes that you personally or Vintage has made in the past, and one is type 1 error, the other is a type 2 error kind of thing. I'm curious, are there telltale signs after all these years of investing in managers, founders, CEOs that you've realized that are either early signals of them not performing as well as you'd want them to, or early signals of you underestimating them and their performance in the future?
I would say that, particularly from companies, that hitting forecasts actually even early is a pretty good sign that, you're doing a good job. I would say some of our biggest and best companies, even early on, were very systematic about that. Obviously, they've made pivots along the way. That's another thing, by the way. Almost every single company, that's been successful at some point was probably doing something a bit different than what they were doing that ultimately made them successful. But definitely having that muscle of saying, okay, let me, present forecasts that I can achieve and, even beat many cases. I think that's actually a really good sign early on. It also, you definitely want, you want your founders in the companies to be visionary, but you also want them to be, realistic on some level as well. And also around things like recruiting, I would say a very early sign that we've seen in companies, if you might think the CEO is amazing, but you want to see that they can recruit amazing people. Now, typically, we're not getting involved in the companies directly until they hit the growth stage, but we are seeing through our fund managers and the portfolio funds when they invest very early. We spend a lot of time meeting the underlying companies even well before we're going to invest. And what we try to do is meet more than just the CEO and look at the backgrounds of the people that they're able to recruit. So I think another telltale sign, again, is just seeing the way the founders and the CEOs build out the team with quality people. I mean, I think that's a very good early sign if you see that.
And how does that interaction usually go? Because you're finding about these early stage CEOs from your fund managers, and eventually you start having these conversations well before these CEOs get to the growth stage, right?
Yep.
How does that conversation usually happen? Do you usually receive an LP update and you're like, wow, this is a company that's performing better than expected or really good. We'd love to engage in the conversation. You reach back out to the fund manager and the fund manager facilitates the introduction, or I don't know. I'm reading the tea leaves here, but
no. So that's, so we're, I would say kind of the fund managers and the funds are at the core of our business. So we work through them and work with them. I would say that's also another thing that we've really been careful with. We started with a secondary strategy, and going back again, doing that 20 years ago. It's a little bit different and more mature today, but it's very, very sensitive. When people need to sell things, they need money, they want liquidity yesterday. Fund manager says, wait a second, why is somebody selling out of my fund? Company saying, why is somebody selling out of my company? So I would say from the beginning, we really brought a big sensitivity to all the various players in this market. And for sure, we want to be sensitive to the fund managers and their portfolio companies. We don't want to be doing anything they don't want us to be doing. They may not want somebody to be approaching their company at this point about getting involved in some way, shape, or form. So first and foremost, we definitely work with the fund managers, whether we're doing a direct deal in a growth company or whether we're doing a secondary deal. The other thing that we do, and again, it's not something that we talked about, but because we have such a large database of companies with deep detail, and oddly enough, because we are based in Israel, we would have, starting probably about a decade ago, have a lot of corporates coming through Israel to find startups. This is obviously one of the biggest startup hubs in the world, and we're really the only kind of animal of our kind over here. And they would end up getting to us, whether it was the Pepsis of the world or the P&Gs or the Walmarts and so on and so forth, looking for startups. And because we like to call ourselves kind of the Switzerland of the VC industry, we became a hub for them to come find these startups. And they would talk to us about their pain points, and we would show them startups. And ultimately, as you could imagine, this actually led to business between startups and corporates. So we formalized something that we call value-added services at Vintage, which actually connects corporates and startups, but more in a pull model where the corporates are telling us their pain points as opposed to us pushing startups on them. What this led to was that our ability to open up conversations with the funds and with companies saying, hey, let's talk about it from day one, how we can add value to you. So, we have this 500, this group of 500 large corporates that we've worked with and done these kind of interactions with. Tell us what you're looking for, and let's bring value before we start talking about transactions, right? Before we start talking. And it's actually over the years led to, a few $100 million in business and almost 300 purchase orders and POCs between corporates and startups that we do all this for free. We have a 7-8 person team here managing that. And it just changes the conversation, right? And, they're getting basically free biz dev, free customer engagements. So again, we go out of our way, both for the funds and the companies, to show value first before we start talking about, hey, what type of deal can we do in your company?
This might get into the semantics of things, but I'm actually really curious on how that engagement looks like, in the sense that when you're talking to a fund manager or a founder for the first time, let's say a fund manager for the sake of this example, are you proactively saying, here, like, we'd love to help you. How can we be helpful? And here are the things historically we've been able to help with. Or do you kind of start the conversation where the fund manager largely says, here are gaps in my knowledge, here are gaps in how well I can support my portfolio. And if you have any one of these, would love to collaborate on that.
We didn't talk about it, but when we started, the firm in 2003, we started with the secondary fund. And then in 2005, did the fund of funds. For the first probably 7 years or so, that was all focused on Israel. So you mentioned in the beginning about the various, the fantastic fund managers that we're invested in. We really had to come from behind. At that point, we had to make our money greener, so to speak. So we had to find a way to help those funds. Initially, it was as they got more interested in investing in Israel, we were kind of like an eyes and ears on the ground for them in Israel, helping them with due diligence on people, finding companies. And then it became this kind of biz dev around customers. So for sure, when we would go out to these funds, we were saying, hey, as you know, the best funds in the world are oversubscribed. It's hard to get in. Why would they take our money? We had to show them value. So it was more saying, hey, here's what we can do. Here's where we can be helpful. And then that conversation definitely evolved into funds approaching us and saying, hey, we would love to help these companies, or, can you tell us, like, leveraging your knowledge, your experience, your data, how to deal with such and such a situation. Some of that might be, what we're seeing in terms around, seed rounds in the aggregate, or how do we see carry split among team members at various stages? How do you think about succession? What have you seen worked at other firms? So it's both at the fund level for their business and then down to the portfolio companies for their businesses. But for sure, the initial door open is us saying, hey, here's what we can do. But for sure, it evolves into, in many cases, not in every case, the funds coming to us and asking us for information, advice, whatever you want to call it, to deal with things that they're seeing in their own business.
Holy frick. I love how every time you answer, I have like 5 more questions for each answer that you give.
Sorry about that.
No, this is great. That's a sign of a great conversation, Abe. So I want to talk about the early days of Vintage, because you did harken back to it back in 03 and 05 and all that. What was the hardest part about getting in investing into emerging managers, fund managers, the best funds? Was it harder to get that initial conversation, or was it harder for them, for you to get them to say, yes, I'll take Vintage's money?
The initial conversation wasn't so hard. Again, we did have the angle of being here in Israel, and suddenly, again, probably somewhere around like 2007 to 8, or right after the downturn, Israel became a much more interesting hub for venture capital, particularly given where Israel's strengths were at the time around, secure cybersecurity and infrastructure, software infrastructure, data, cloud, what have you, DevOps. That became more interesting to venture in general. So, and we all had past relationships as well. I actually, again, from the public equity side, Alan as well was on the public equity side as a banker. And then as a venture capitalist. So we leveraged those. There was foreign funds that were active in Israel. So I would say kind of getting the first conversation was a big challenge, but getting the yes wasn't easy. It actually started because there were a couple funds that we were showing value to them. This was back in, I want to say probably 2008, 9, the way I described it. And they actually kind of invited us to say, hey, would you like to participate at the time with a very, very small check in what were their very oversubscribed funds, as a way to say, okay, thank you for the help that you've been giving us. And again, that's kind of where things started to fall, where you started saying, hey, that we could leverage this in order to get into some of some great funds outside of Israel. If we can do that, why not? But nothing was easy. That's for sure, and it's a lot of hard work. And I always say, and again, this is also something I like to hear when we're interviewing people, or we talk to our fund managers, stories around, if you couldn't get through the front door, you went through the window, right? And how did that happen? So nothing's easy, but it's a lot of hard work and patience. And again, showing value. Like that's what we did.
Pulling on the analogy, if you can't get through the front door, you go through the back door, you go through the window, you go through wherever, you go through the garage, you go through wherever you can. I imagine in Vintage's early days, there was a lot of cold calling, cold emailing, just knocking on doors effectively. And if you can't get in, you find other ways to get in, right? And now at this point, you're probably at a point where you're seeing a lot of people cold email, cold call you. In your mind, reminiscent of your early days, what are the great mechanics of a great cold email or a great cold call or a cold message?
I mean, look, it might be different for different people. For me, I kind of like things that are short and to the point. I'm definitely heavy on email, and I get a lot of emails, so I think that's really important. Particularly if it's somebody with like a fund or a company that's trying to raise, definitely sharing a deck that's attached at the outset. I always appreciate that, as opposed to like a link through a DocSend or something like that I need to put in an email and download, and just to keep it simple. I do try to respond to nearly everybody that does that at least one way or another and do that quickly. So I think that's really important. And also, and again, this is also another interview thing, somebody who's kind of done their homework and looked and see, hey, this is what Vintage does. How does this fit in? Like, I see you've done this, this, and this, we know them, or do this, or this is a connection, or we fit nicely into your portfolio. Maybe you haven't spoken to us. I mentioned on the interview side, like I love when we're interviewing candidates for Vintage, at the end when they have questions for me about our business and I see that they've done their homework. I just think that's really, really a good sign. So I would say that's what I'd like. So kind of short email, if there's material that it's attached and somebody who can kind of very quickly tell me kind of how this fits in, why they think it would be a good fit for us.
I would love for you to debug something really quick. One of the things I wrote on my blog is, at least my, in quotes, template for a cold email.
Yep.
And largely what I do myself, and as well as I recommend others, is the very first thing that you have is a metric or something that like stands out. Like you're like better than 99% of the industry. Like we're numbers people. We gravitate towards that, right? That could be in the subject line. That could be in the first sentence. And then the second part is you have 2 to 3 lines of why your fund is awesome or like why you're amazing. And then the third of which is really why this investor is the best dollar for your cap table. And that third part is probably the most important because it requires just personalization that you can't templatize. Yep. I'm curious your knee-jerk reaction to that and if that makes sense in terms of the format that people send you emails in.
Yeah, that makes sense. I would just say you have to be very careful. We get a bunch of emails saying, top decile fund and blah, blah, blah. And then you kind of dig deeper and you see there's a lot of like fuzziness to that. So I think you got to be a little bit careful not to massage the numbers too much. That's something else that I, would say, to speak very straightforward about that. The other thing that I would add to that, again, if there's any, common connections, it might even be individuals. Hey, I see you guys are investors I'm very close with, whomever, whatever, those types of things. So again, somebody who's kind of done their homework as to what we're investing in at the same time can make something a bit more, personal around that and connected so it doesn't feel too generic. But I think what you're saying is, definitely love to see the data. Definitely love to see why, whatever this investment opportunity is going to be the winner, differentiated. And again, why it fits, in this case, Vintage's strategy. I'll get a lot of like cold emails saying, oh, I have a seed company that we'd love to, and like very easily, I think if you do some searches a little bit, you can see, what we do on the direct side versus not. Again, or whatever it is, growth equity to PE type fund, which again, we're not investing in. So I think that's important, like where it really fits in.
In your mind, we're taking a severe detour from the schedule. But what is the hardest kind of no to say when you get an inbound that you're just like, this is awesome?
In what sense? What do you mean the hardest no?
Hardest no in the sense like a fund manager comes to you. Let's take a real example. Like a fund manager comes to you.
Yep. You
think they're awesome for whatever wavelengths. You can fill in the blank X, Y, Z variable.
Yep.
But you still have to say no. of those what are those XYZ variables that are very hard to say no to, but you still have to say no to?
Okay. Well, look, I would say I think if they're awesome and something resonates with it, I'll say let's continue the conversation. I would say these days with venture capital funds, we definitely gravitate towards smaller funds. We do have some amazing managers who, manage funds or platforms that are $1 billion or above, but the number of groups that actually do that are very, very small. So if I kind of see somebody, come in with a second fund that's, again, this is just a very generic answer, that's $500 million, or somebody who says they're doing seed investing with $500 million, but it looks like they're getting into great deals and they're amazing people and so on and so forth. Those are some things that we might just have to say no to because of that, and hopefully it might be a miss, but those are things that we think it would be no to. But what I would say though is if I see something that's interesting and resonates with me or anybody on the team, it's going to get attention, and it's going to sort of move up the chain. So hopefully I don't love saying we say no much more than we say yes, but I would love to say yes. So if I see something interesting, I'm gonna dive deeper.
Amazing. And you mentioned you have a preference for small funds, and I don't want any of these numbers to be prescriptive in nature, but in terms of general ballpark things as a function of stages in which funds invest in, how do you define small?
Yep. So I would say this, like we gravitate towards the earlier stages of investment when we're looking at fund managers. With that being said, we do have a handful of growth funds as well with some managers that we think are fantastic. But for the most part, most of our fund of funds portfolio is an earlier stage. And by that, I mean funds that are starting in the pre-seed, seed, maybe up to A rounds. So if I kind of think about pre-seed and seed, I generally, and particularly pre-seed, I wouldn't want to see those funds start getting like well north of, 150 million, 200 million. I would kind of say the sweet spot is anywhere from kind of 50 to 150. Again, this is in the large, right? It's not in every case. And then as these funds start becoming more seed and A round funds, that's kind of like, the 200 to the 500, 600, 700 million. As they start getting above that, that starts to feel too large as well. And a lot of that, again, is just where ultimately most of the capital is going to go, right? Like what you don't want to do is invest in an early stage fund where at the end of the day you look back and most of the capital went into B rounds and above, which can be the case as your fund gets too large. So I'd say those are kind of rough guidelines around that. But we've seen funds succeed with smaller and larger and everything in between, but for the most part, it falls in kind of those ranges.
Totally. And as the Mike Maples dictum says, your fund size is your strategy. Yeah,
100%. And he says a lot of things extremely well, including that. So Mike knows what he's talking about. We're very proud investors with him as well.
I love that. Yeah. He is. And I don't have nearly as close of a relationship as you do with him, but I will say the sound bites and the things in which he writes about and like speaks about is just very framework driven, which I extremely love because there's an immense amount of data out there. Speaking of just data, right?
Yep.
And he's able to take this chaotic soup of data and make sense out of it, which I think is very, very powerful in nature.
Yep. We had Mike on a panel at one of our VC summits a number of years ago. And I would say Mike is actually the exact type of person who I get the sense is going to talk a lot more about his learnings and mistakes than he often talks about his winners. And again, I think that's fantastic. And he's had a lot of winners. So
he's had a lot of winners. You're completely right. And you've seen it all. You've seen it all. Okay. Just, I want to, if you might humor me a little bit, sure. I want to go back to something that, where you offer value to your fund managers. And you mentioned that people often come to you for conversations like carry split, or how should they think about succession planning.
Yep.
And just to take a very real example, like I want to role play a little bit where
Sure.
I'm a fund manager coming to you asking, hey, you know what? I'm a solo GP. I'm raising a fund 2 or fund 3. Let's say fund 2 for now, for the sake of this example. I want to bring on another partner, and I want to bring on someone more junior on the team as well. Let's say an analyst or an associate. How should I think about carry split? Because before it was like 20% is completely mine, or like, right?
Yep.
But now that I'm splitting the pie, how should I think about it? What would you recommend?
So, like, first of all, I'm definitely of the opinion that everybody in the firm should get carry. It's something that we do here. It just keeps everybody on the same ship, steering in the same direction as much as possible. I think it's the right incentive. So, even in our case, even down to the administrative assistants, who again are extremely important at the firm, they all get part of the carry. So I would definitely say, like, whether it's junior, partner, or whatever, I think that is the right approach. The other thing that I would say is, again, it also, there's a lot of nuances here, depending who that individual is. If it's somebody that you've known for a very, very long time to work with, which I would highly recommend being the case when you're bringing on somebody as a partner. But typically what we'll see is kind of that first go round, if you've already brought them on as a partner and you feel comfortable, it might not be an equal split, but within, 1 or 2 funds, it gets to an equal split. Assuming that's the nature of the partnership, that it's going to be, that you're going to have an equal partnership. So it doesn't necessarily have to be that first, that fund 2 that you're talking about where you're bringing on the partner, but I would definitely want to see a path, fund 3, fund 4, where you're getting to an equal partnership.
For that ramp up, effectively, let's say like for fund 2, it's not equal yet. Maybe fund 3, fund 4, it's equal. Where should I start thinking about fund 2? Like, should I be allocating 30%, 40%? Like, how should the ramp up look like?
Yeah, I would think about it that they may be getting kind of like half of what you're getting. Again, you're the founder. You started the firm. You took the risk. They're obviously taking a big risk as well. I mean, again, it's a fund too. Let's be honest.
Right.
But I would say that's probably ballpark when I would think that maybe you're getting 2x what they're getting, and then again the next fund or the fund, and then it either graduates, or even if you're already seeing that they're a critical part of the firm and what's going on, then even by the next fund, it could be that you're splitting it equal. And I've seen that in a lot of cases as well. So that's kind of how I would think about it, kind of the guidelines.
And I also mentioned that, in this role-playing example, that I wanted to bring someone more junior on the team. And typically, if you invest in a seed stage company or whatnot, you usually ask to open up, if they haven't already, an employee option pool.
Yep.
At least for fund managers, and let's say you want to scale your team, is there the equivalent on that wavelength? Like, I should open up a similar pool for more junior hires or other team members on who will join?
Yeah, if that's, I definitely would think about it that way. I would keep that flexible, because I imagine over the course of the fund, you might want to add even more than one person. It's kind of also thinking about making a pool for advisors. I think that's also really important. Again, it doesn't need to be substantial in the beginning. And there are a lot of nuances, obviously, in terms of the experience and talent, and whether you think about these people for the long term or not. But I definitely would give them something. So that's I think that's really important. And by the way, I think for you as a fund manager, or for the fund manager, that's also an important signal about what their incentives are, what their culture is. So I think that's extremely important.
And obviously, there's no one right answer per se, but just like in an employee option pool, if you're opening up in their first institutional round, it's usually 10 to 20%, give or take.
Yep.
Does that seem fair for? I'm making up the terminology, carry option pool.
I mean, like, again, I think you need to attach it to the plan of how many people you're planning to hire. It's a little bit different.
Yeah.
In the startup sense, because again, you're probably going to be hiring a lot more people. And again, I think for a person who's not at the partner level to start out, as long maybe for somebody who you're not sure even if they're going to be with the firm in a few years, it doesn't need to be something significant, but I think it needs to be something, right? I think that's the point. And I do think as that individual progresses, if you see that they're a keeper, then you're going to want to very quickly up that. So it's kind of more but it doesn't have to be as substantial as you would for a startup. Again, just kind of thinking about the math on the fly.
That's fair. Does it make sense? And you just give me like if this sounds directionally accurate, right? So let's say I hire an analyst or an associate and I give them, let's say, percent of the carry of the fund.
Yep.
And as I bring on advisors, I give them, depending on their level of expertise and depending on their level of involvement, it ranges anywhere between like 2 to 5%, depending on their involvement for a fund too. Does that seem directionally accurate?
Yeah, I think for advisors, and again, I hope you have no advisors listening to this, but I think that you could give them less. I think it's more, again, you could even give them less than 1%. I think for the people that are working full time at the firm, that's their 24/7 job, then I would give them more than the advisors, unless of course there's somebody extremely special who's really involved, and you got to take that into account. But I think of the people who are at the firm, working on the team, that they should get more than somebody who's, again, just an advisor or something like that. Again, unless the advisor, for example, brings like half the capital or what have you, or is amazing deal sourcer. And I do think even at those earlier levels, the numbers you talk about are right, but it doesn't need to be something significant to start. It's just that they're getting it. And then again, you can scale it up as they prove, their worth. But I think, again, it's more important just even psychologically to show them, what you value, and that, again, it's a team, that they're not an employee per se is the way I would put it, that they're a team member.
That also blends itself well into another example in which you shared, which was succession, right? If you're thinking about succession nearly and dearly, as you're thinking about these funds and these ramp ups for the partnership or for more junior team members becoming partners in the future, showing that thought process across funds, or at least how you're thinking about it now, helps a lot in terms of gaining confidence of like, this is going to be a multi-generational firm and not just like a one and done solo GP thing.
Yep. No, 100%.
Not saying that solo GPs aren't thinking about legacy. I'm just, that was the first example that popped into my mind.
Okay.
100%. I want to take a left turn here, but I also want to fulfill a promise that I made during the introduction, which was to talk about your re-up rate of 90%. I found that on interweb, so if that is wrong in terms of numerical value, let me know. But what I'm curious is, as a fund of funds who has just like a 90% re-up rate, where you invest 9 out of 10 funds you've invested in before, of commitments north of $5 million, the question I have for you is, who qualifies to get re-upped, and who is that 1 out of 10 manager that typically, not always, but typically doesn't get re-upped?
No, it's a great question. That's the way described is exactly the case. Usually what we'll see is kind of one of three things. It could be that the fund just scales up in size way too much. So what we invested in originally in the strategy, go back to what Mike said, what you quoted, changed from what we originally were investing in. And that's the vast majority of it, that it's just scaled up and it's less relevant for what we do as a fund of funds. I would say we've also seen cases where there have been significant team changes. And again, it's rare, but it happens. And then suddenly you're not exactly backing the same thing that you were originally backing when you went in. And then the last thing I would say, again, come down also just to strategy and performance. And it could be just that over time you see the performance is just not as good as it was in the past. Or again, maybe the strategy is changing a bit even without that increase in size. And it usually falls in those two buckets. I would say the most part, it's been fund size has been a reason why we've stopped with some of our managers. In some cases, a bunch of our investors are very large institutions who can write very, very large checks. In some cases, we made intros with those groups directly who might want more of a larger platform play than what they would get through our fund of funds. But those are the main drivers. When we make a commitment to a fund with a meaningful check, we do a lot of work. In some cases, it can surprise some fund managers. And the main reason is, again, we see this relationship as not being, okay, I'm investing in this one fund, but ideally I want to invest in your next 10 funds if I can, but for sure, at least your next 3. So we put in a lot of work, we spend a lot of time, we ask a lot of questions, hopefully in a nice and pleasant way. but that's the key thing, because we don't want to be dropping funds. And we often make it very clear up front, like this discussion, what would cause us to jump off the train. So as much as possible, that's clear in the beginning. And that's fine if they want to change their strategies, and more power to those that want to do that and go through that. And some have done it very, very successfully, but that's just not for us. But that's the critical thing, is trying from day one and in the beginning, when we make that first commitment, to be as clear about those things as possible.
As we close this out, I want to ask you a couple things. One, I want to rewind the clock back to the days when you made your first big purchase. If you remember, that was the Atari 2600.
How did you know that?
How did I know that? I wonder. I really wonder. For the uninitiated, can you explain to our audience what being a Pitfall Explorer is?
Sure. I'll do my best. And first of all, I'd love to come back and spend time talking about secondaries as well. Again, we've been doing it for 20 years before, when I think back to 2003, 4, 5, when we started, and how much market education we had to go through to explain even that you could buy an LP out of a fund and that you can buy shares out of a company. It's pretty amazing to see where we in the industry have come since then. So we definitely do that. But Pitfall was a game by Activision, and I had the Atari. Again, I don't know. People should definitely look it up if they don't know what that is. And it was you had to buy cartridges and stick them in the console in order to play the games. And Pitfall was my favorite game, and it was like one of these I guess you call it the runner games, but this was in 2D on a black and white TV screen basically, and you had the explorer had to run across different pitfalls, including lakes with alligators, and grab a rope to swing over it, and as much as possible get to the end, wherever the end might be. But of course you get to the end, and then it brings you back to the beginning with a higher level and more obstacles to get there. So I spent a lot of time in my basement playing that game and getting blisters on my hand from the joystick and getting very, very high levels, and ultimately did really well that I was lucky enough to get a high enough score that if I sent a picture of the screen into Activision, to their headquarters, I believe it was in San Diego, they would send back a nice patch that I would wear on my jacket. So I spent a lot of hours playing Pitfall and being a Pitfall Explorer. And
I want to make this a little bit more concrete here, because that score that you had to achieve was, if I remember correctly, 20,000 points. And for anyone who's trying this, that's a very tough score to get. And not only that, once you take a picture, a Polaroid, you have to mail it in all the way in San Diego. You're all out in Baltimore. Wait 2 months before they get back to you, and then you get a badge. So I'm curious, what has being a member of the Activision Pitfall Explorers Club and all of its facets from a very young age taught you about patience?
Oh, for sure. I mean, I'm very proud of that moment. but and it's amazing that I was able to find, I still have that Polaroid, which is pretty incredible.
Oh, that's amazing.
We might have to explain to people what a Polaroid is, but that's, again, something else.
I think it's coming back in fashion.
Is that right?
Back in fashion.
Nice. Yeah. I like that. I'd like to get one. There's an element of patience and perseverance and just kind of going through things time and time again to improve on what you're doing. So I would say, again, while playing it, I'm not sure that's what I was thinking, but for sure that instills it into me. I'd also say you definitely need patience. I think we experienced that, again, going back to 20 and 2021, seeing how the market was just completely out of control. And it was so hard to do deals, and we really scaled back our investing, and that's not easy. Investors give you money to put to work and to make investments, and we would see amazing companies and amazing funds, and we would have to put the brakes on. So you would say after every year would go by and you didn't see the market turning, and we were saying it probably for 5 years, you start to question yourself. So you definitely need patience. And I think, again, that game of having just to keep being the perseverance and the patience. The other thing I would say as well is that sometimes you can't be too patient. You can't sit on your hands. Part of the game was that, sometimes you had to really run through it quickly, and you couldn't wait for again, forgive me, the alligator mouth to open. You just had to jump on their heads and get through it fast, or you'd miss your chance. So you don't want to be too patient in this business either. And it just means always kind of thinking about what's coming around the corner, what's coming next. Again, going back to the beginning of the conversation on our offsites, we talk a lot about that. Not just doing the same thing, over and over again. So again, going back to the video game, if you fail doing something, if you fell into the pit, into the lake, got bit by the alligator, figuring out a different way of doing it. And I think that's important. So you need the patience, but you can't be too patient in this business, or it'll just pass you by.
I love how you mentioned mistakes, because I want to come full circle here. Mistakes has been a theme of this episode, and I'm always a big believer. It's a question I love asking our guests, but I'm always a big believer that the greatest investors have always been the most humble. And a large part of this podcast is really to paint the humanity behind the world of LPs. Most people in this LP landscape, including yourself, have a phenomenal resume. Like, you were at Goldman Sachs, you started Vintage back in, like, you and Alan and your team started Vintage back in 2003. And so there was a lot of this going on. And you can find all the ways you shine on LinkedIn or on their one pager. But I'm always a fan of the antithesis of all this, which is what I call the anti-resume. So I've one myself that literally highlights all my biggest failures, all my biggest professional mistakes. Like, it's literally like everything I've done horribly at every single institution I've been across, but to remind myself the humility of taking on these roles. So I'm curious, when was a time that you've made a professional and or personal mistake in hindsight and fell prey to the snapping crocodiles or the deadly scorpions, in the words of Pitfall Harry?
Wow, that's a good question. I mean, look, I'll go back to the beginning. I mentioned I was working for the guy that I mentioned, and we were focused on Israel, and we were actually probably about 6 months in. Again, I don't recall if I mentioned we were hired by another investment bank, and I started getting a salary, which was nice. And I don't remember, it was like a couple years in, I started feeling like, okay, I want to go off on my own and do my own thing, and maybe see what else is out there, maybe not related to Israel in this case. And I went to join a boutique investment bank, also in equity research. And, it was probably too soon, and I didn't do a great job. And I want to say maybe 9 months to a year in, I was actually let go. So that was a big blow. Was very, very difficult. I'd actually just moved from Baltimore up to New York to take that job. And again, 9 months goes by quickly. So I would say I probably, again, everything worked out, thank God, right? So I'm here where I am today, so it was all for a reason. But I think that was it. I probably went too quickly and had more to learn before running to take that role at a different firm. And also, I would say, again, it wasn't specifically related to something that I loved, which at the time was, Israel and tech. And so maybe part of that, maybe my heart wasn't as in it. And I think that, again, taught me a lot, that very early in my career that I had those kind of dramatic changes. I think we talked about before, my parents are educators and teachers, and my father worked at the same university for over 40 years. So, very early in my career, having, worked at a couple of different places and getting let go was a big, big blow, and very different than what I grew up with. But I would say that, that made me kind of look in the mirror and say, hey, what do you want to be doing? What do you want to do with your career? Very quickly after there, I went to, another firm doing equity research, working for somebody else at a lower position covering technology. And then immediately afterwards going to another group, focused again back on Israel. So that was a very important moment in my career, kind of a wake-up call, I would put it.
And although you hopped around early in your career and you learned a lot, built up all that scar tissue, you've been at Vintage for 20 years, and you're going on to 21. So you're almost at your drinking age while you're at Vintage over here. So I think your parents taught you well. Like, at some point, I don't know, I'm reading the tea leaves, you might be hitting that 40 years at the same institution and just building great work there.
Yeah. Oh, look, I appreciate. Well, I'm not going anywhere if they want to keep me. And again, a lot of that I have to go back and just give credit to Alan that's the culture that he put into the firm. All the partners of the firm, aside from Alan, didn't join as partners. They grew up from within or from venture partners from the side. And I think that's also been a big part of the culture. And we touched on succession as well. That's been something that we've been focused on for not quite a decade, but for the past kind of 7 or 8 years, is how to do a proper succession and make sure that's clear and open, both internally to the team and also to our investors. And again, kudos to Alan for building that process and culture here, and hopefully I can take that forward and then hopefully give that to other people here who can take Vintage forward for another 21 years with or without me.
Well, Abe, this has been thoroughly enjoyable. I want you back. I want you back already.
With pleasure.
Secondaries is a whole podcast episode.
Yeah, we got to do that.
Itself. We got to do that. We will find time. I'm making that promise to myself and to you that we will find time to do an episode 2 on this. But Abe, this has been thoroughly enjoyable. I think I've learned a lot. I think our listeners and viewers would have learned a lot. I'm putting words in their mouth, but I want to say that a lot of them will be like, I took something away from this episode. If people wanted to find you, and obviously you're everywhere, but what is the best way? You mentioned you check your emails often. Is that the best way?
Email's the best way. It's abef@vintage-ip.com. But feel free.
You honestly, I think you might be one of the few domains that have a dash in it.
Yeah, well,
so you can't forget.
That's right, exactly. Vintage was it's too generic, but yeah, we are. It's always a challenge for me to tell that to people. But again, abef-ip.com.
It's memorable. It's memorable. You're memorable. Thank you so much. This has been so enjoyable. We'll have you again. And for all the folks listening, hope you learned something from this.
David, thanks. I really appreciate the time, and I love what you're doing. So keep it up. How did you know that?
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are 2 completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for 2 reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist, and I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up, and as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, "John, you're free to stay here for as long as you want." And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault. And it is the epitome of Peter Drucker's infamous line, which is, "You cannot manage what you don't measure." And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of, LaunchDarkly, Prevacera, MoEngage, and we're also backed by some incredible LPs and investors, including Coastal Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. They're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next, or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.